Welcome to Section 2 of the ASC 718 SBC training series. In Section 1, we established that SBC is a real cost and mapped out the main award types. Now we get into the two most consequential technical decisions in the entire standard: how to classify an award as equity or liability, and how to measure the fair value you will expense over the vesting period. These two decisions drive everything else that follows. By the end of this section, you will be able to apply the equity versus liability classification test to any award and understand why this classification decision is so consequential for income statement volatility. You will be able to identify the correct fair value measurement method for each award type, whether that is the stock price, the Black-Scholes model, or a Monte Carlo simulation. You will know the 6 inputs to the Black-Scholes model and understand which direction each one moves the fair value. And you will understand why expected volatility is the most sensitive and judgment-intensive input in the entire measurement process. Here is the single most consequential decision in a SC 718, and it is one that teams sometimes make without fully understanding the implications. If an award is classified as equity, you measure fair value once at the grant date, and that number never changes. Every quarter, you simply expense a proportionate slice of that fixed amount. If an award is classified as a liability, you remeasure it at fair value at the end of every single reporting period. Every time the stock price moves, that movement flows through compensation expense. A company with liability-classified awards will see its SBC expense rise when the stock goes up and fall when the stock drops, creating ongoing earnings volatility that is very hard to predict. Most companies work hard to structure their awards as equity classified precisely to avoid this. The test for equity versus liability classification comes down to one question: who controls whether this award is settled in cash or shares? If the company decides and it chooses shares, it is equity. If the company must pay cash, or if the employee has the right to demand cash, it is a liability. There is also a fixed-for-fixed test for equity classification. The award must be for a fixed number of shares at a fixed price. If either the number of shares or the price varies, say, the award promises shares worth a fixed dollar amount rather than a fixed number of shares, that variability creates a liability. Cash-settled SARs and phantom stock are the clearest liability examples. Watch out for situations where the company has a practice of settling awards in cash, even if the contract allows shares. That practice can be enough to require liability classification. The measurement method depends entirely on the award type. For RSUs and restricted stock, fair value is simply the stock price on the grant date, adjusted downward if the employee does not receive dividends during the vesting period, because dividends reduce the value they will ultimately capture. For stock options, you need a proper option pricing model. Most companies use Black-Scholes Merton, though a binomial lattice model is also acceptable and is sometimes more appropriate for awards with complex features. For PSUs tied to total shareholder return relative to peers, the market condition must be incorporated into the fair value using a Monte Carlo simulation. And for liability-classified cash-settled SARs, you use Black-Scholes, but you run it again at every period end because the award must be remeasured. This is what creates the P and L volatility we discussed on the previous slide. PSUs deserve special attention because they split into two categories with very different accounting treatments. If a PSU vests based on a service condition and a non-market performance condition, say, hitting a revenue target, you measure fair value using the grant date stock price, exactly like an RSU, but you adjust the number of awards expected to vest every quarter based on your updated view of whether the target will be achieved. If a PSU vests based on a market condition, such as total shareholder return relative to an index, you need a Monte Carlo simulation to measure fair value. The simulation models thousands of possible stock price paths and calculates the expected payout across all of them. Once that simulation is run at the grant date, the fair value is locked in. You do not adjust it later based on whether TSR actually exceeds the target. That probability was already reflected in the initial fair value. The Black-Scholes-Merton model takes 6 inputs and produces a fair value per option. Let us walk through each one. Stock price is the closing market price on the grant date, simple. Exercise price is the price at which the employee can buy shares. For most grants, this is at the money, meaning the exercise price equals the stock price on the grant date. Expected term is the expected period from grant to exercise, not the full contractual life, because employees typically exercise early. Public companies with limited data use the SEC simplified method. The expected term equals the average of the vesting period and the contractual term. Expected volatility is the expected annualized standard deviation of the company's stock price returns over the expected term. We will spend a whole slide on this one because it is the most judgment-intensive input. The remaining 3 inputs are the risk-free rate, expected dividends, and bringing the 6 together, they combine through the Black-Scholes formula to produce a fair value per option. The risk-free rate is the yield on a zero-coupon U.S. Treasury bond with maturity equal to the expected term on the grant date. It represents the time value of money. The higher the risk-free rate, the higher the option value, because the present value of the exercise price is lower. Expected dividends reduce option value. When a company pays a dividend, the stock price typically falls by the dividend amount on the X date. If the option holder does not receive dividends during the vesting period, which is usually the case, the expected dividend yield reduces the value of the option because the stock price will be lower than it would have been without dividends. Companies with no dividend history typically use 0. Expected volatility is where most of the judgment in option valuation lies, and where auditors focus their attention. A 10 percentage point change in the volatility assumption can change the option fair value by 15 to 25%. That is enormous. For public companies, the approach is fairly well defined. Use historical stock price volatility over a period roughly matching the expected term, sometimes blended with implied volatility from traded options if available. For private companies, there is no stock price history to draw from. The standard practice is to use a peer group of comparable publicly traded companies, selecting peers with similar size, industry, and stage of development. Choosing this peer group requires professional judgment. It will be reviewed, questioned, and documented in an audit. Get it wrong and it flows directly into the grant date fair value and the cumulative SBC expense for every option in that grant. Here is the directional intuition for all 6 inputs. A higher current stock price means the option starts closer to being in the money, higher value. A higher exercise price means the employee needs the stock to rise more before the option is worth anything, lower value. A longer expected term gives the stock more time to rise above the exercise price, higher value. Higher expected volatility increases the probability of large upward moves, higher value. A higher risk-free rate reduces the present value of the exercise price the employee will eventually pay, higher value. Higher expected dividends deplete the stock price over time, lower value. Volatility and expected term are the 2 inputs with the largest impact on fair value, which is why they receive the most scrutiny in an audit. Classification and measurement are the first 2 steps of the 5-step ASC 718 process, and they set the trajectory for everything that follows. Step 1 asks whether the award is equity or liability classified. We have covered the test in detail. Step 2 measures the grant date fair value using the right method. Stock price for RSUs, Black-Scholes for options, Monte Carlo for TSR-based PSUs. Step 3 identifies the vesting conditions, service only, performance, market, or a combination, which determines how expense is recognized over time. Steps 4 and 5 deal with expense recognition, forfeitures, modifications, and EPS impact, all of which we cover in sections 3 and 4. The output of steps 1 and 2 is a single number, the grant date fair value per unit. Everything from this point forward flows from that number. Classification and measurement are the technical bedrock of a SC 718. Get the classification right first: equity, if the company settles in shares and the employee cannot demand cash; liability, if the employee can. That single decision determines whether you recognize a stable, predictable expense or a volatile P&L item that moves with the stock price every quarter. For equity awards, fair value is measured once at grant and never revisited. The measurement tool depends on the award type: stock price for RSUs, Black-Scholes for options, Monte Carlo for TSR-based PSUs. Of all the inputs to Black-Scholes, expected volatility carries the most weight. A small change in that assumption can meaningfully shift the entire grant's compensation cost. In Section 3, we take the fair value we have just measured and ask, over what period do we recognize it, and what happens when performance conditions change the number of awards expected to vest? Thank you for completing this section on classification and measurement. Thank you for watching. Subscribe for more training from PNJ Group.